Have you ever looked at something and just thought, wait a minute, that doesn't add up? Well, that's exactly the feeling you get when you look at the Indian stock market right now. It's a genuine puzzle, a paradox that's got investors and analysts all over the world scratching their heads and asking one simple question: how is this possible? So today, let's piece this thing together. Okay, so first, let's talk about performance. For a while there, the Indian market was on a tear, right? But recently, it's kind of cooled off, especially when you compare it to what's happening globally. For the 2025 fiscal year, it actually ended up as the 7th best performer in the world. I mean, it's a positive return, which is great, but it's definitely not leading the pack. And here is where it gets weird. Here's the twist. Despite that kind of middling performance, India's stock market is the second most expensive major market on the entire planet. Only the US costs more. Think about that. It's growing slower than a bunch of other markets, but you're paying this huge premium to invest in it. So how on earth is that possible? That's the puzzle we're going to solve. So let's dig into part one of this mystery, the performance. How exactly does India stack up when you put it on the world stage? Now, this chart really puts it into perspective, doesn't it? It's all about the scale. While India posted a respectable 5.3% gain, just look at Hong Kong. It came roaring back with a nearly 40% surge, and even a market like Germany saw gains over 19%. Next to those numbers, India's performance feels, well, pretty quiet. So you'd think, okay, if the returns aren't exactly setting the world on fire, the price must be cheap, right? Well, not so fast. Let's flip over to the other side of this paradox, the price. Now, in the market world, we have a great little tool for this called the price-to-earnings ratio, or PE ratio. It's simple, really. It just tells you how many dollars you have to pay for $1 of a company's profit. And wow, this is where you can really see that India premium people talk about. India's PE ratio is sitting around 21. Now, compare that to its neighbors. China is trading at under 10. Hong Kong is under 12. You are literally paying almost double for a piece of the Indian market compared to others in the region. For years, the justification was always India's incredible growth potential. That potential had a price. But here's where it gets a little more complex. There's another layer to this. While India is definitely expensive compared to the rest of the world, it's actually gotten cheaper compared to its own recent history. Today's PE of 21 is a good bit lower than its 5- and 10-year averages, which are both up around 25. So what that tells us is the market has cooled off from its own highs, even while it stays pricey on the global stage. Okay, so just to recap, we've got a market that's underperforming its peers, but is still one of the most expensive out there. This is where the story takes a really dramatic turn, because the answer lies in this massive tug-of-war happening between two incredibly powerful groups of investors. Let's just start with a basic market principle. Common sense, right? When the big players, the huge global funds, the foreign institutional investors, start selling off their stocks, what happens? Prices should go down. I mean, they're pulling billions of dollars out of the market. And they have been selling, looking at the high valuations and deciding to cash in their chips. But the thing is, prices aren't falling. And the reason the market isn't tanking is because there is another force on the other side of the rope pulling with equal, if not greater, strength. For every single share a foreign investor is selling, India's own domestic investors, we're talking mutual funds, insurance companies, and millions of regular people, are right there stepping in to buy them up. And you don't have to take my word for it. The numbers make this crystal clear. Just look at these figures from September. On the 11th, foreign institutions sold off over 3,400 crore rupees worth of stock. In the old days, a day like that would have sent the market into a nosedive. But on that exact same day, domestic institutions bought over 4,000 crore. They didn't just absorb the selling, they bought even more. This is the key. Domestic buying is putting a solid floor under the market. And this quote from strategist Arvind Chari just nails it. It perfectly captures this new reality. For the very first time, the fate of the Indian market isn't being decided solely by foreign money. There's a new boss in town, and it's domestic. So the big question is, where is all this domestic money coming from? This isn't just some flash in the pan. What we're witnessing is a deep, fundamental, structural shift in the very foundation of the Indian market. It all starts right here, with the incredible rise of the individual Indian investor. The number of demat accounts, which you need to trade stocks, has just exploded. We're talking from about 40 million back in 2020 to over 175 million today. That is more than a four-fold increase in just a few short years. And it's unleashed this torrent of domestic savings into the market, a lot of it through these steady, disciplined, systematic investment plans, or SIPs. And all that new retail money has pushed us past a historic tipping point. You're looking at it right here. For the first time ever, the total ownership of Indian stocks by domestic investors, now at 18.5%, has officially surpassed the ownership by foreign investors, which has slipped to 17.5%. The balance of power has literally shifted. Now, this newfound strength in the market, it isn't happening in a vacuum. It's really important to zoom out for a second and look at the bigger economic picture that's giving all these domestic investors so much confidence. You can see the signs of a maturing economy everywhere you look. You've got a booming IPO market. That means companies are confident enough to go public and raise money. You've got a corporate bond market that's growing like crazy, giving businesses more ways to get funding. And of course, the big one, you have the IMF forecasting strong GDP growth that's set to outpace most of its global peers. All of these things together create this bedrock of confidence that's fueling this domestic investment wave. So there you have it, the paradox of an underperforming yet overpriced market. It's all explained by this incredible transition from a market that used to depend on the whims of foreign money to one that's now being anchored by its own people. The big question we're left with is this: has this shift truly built an unshakable fortress around the Indian market? Or is the next big test for this new foundation just around the corner?